So, an investor's guide to wealth creation and rational optimism. My goal here for you today is, hopefully, if you've never been through this class before, that you see the world from a different perspective. And if you've been through the class before, this will give you a refresher course and help you get through the rest of the year, because you're going to be seeing all kinds of bad news all year round, right? That's what comes in the news. And Scott and I, we can't be with you 24 hours a day. So hopefully you'll remember this class and it'll give you some perspective. So I'm going to have to change the class up a little bit. I had to change the class up a little bit today because we did go through a recent downturn, right? The last quarter started in September, went through October, and became pretty significant in December. So you guys are here today. I owe it to you to kind of address that situation. So you can be rationally optimistic, but the key word is rational optimism. And I always issue this word of caution. Just like we don't panic in down markets, we don't get greedy in up markets either. In 2016, when I was teaching the class, we had the worst start ever in the news. I don't know if you guys remember the beginning of 2016. Then in 2018, when I was teaching the class, we seen after about 13, 14 months, markets hitting new highs after new highs after new highs after new highs. Then everybody wanted to buy more stocks after it's hitting new highs. So we give that same caution. Let's go back to the tape. This was January 27th, 2018. You can be rationally optimistic, but the key word is rational. Rational optimism. Right now, we just saw this a couple weeks ago, Dow broke 26,000 on the Dow Jones Industrial Average. Seeing that all over the news. It's been a constant story for about a year and 3 months now, right? So we have to be careful though, just a word of caution. Just like we don't panic in down markets, we don't get greedy in up markets. It can change in an instant. Yes, it can change in an instant. Now, little did I know when I was teaching that class that the fourth quarter of 2018 is when it would change for us. But these are temporary changes. If you're prudently invested, I'm going to show you throughout the class today that it's not something to be tremendously concerned about. But this is what we were seeing December 18th. Look at this quarterly performance. The Russell 2000, small caps, minus 20%. NASDAQ, minus 17%. Then you start seeing this stuff in the news. We're now in a bear market. Here's what that means. Dow dives, worst Christmas Eve trading day ever. December 22nd, 2018, Russell 2000 from its all-time highs, minus 25%. NASDAQ, minus 21%. And then when we add Christmas Eve onto that, the S&P 500 hit that minus 20% number when we got that Christmas Eve added into it. Then December 25th, 2018, the worst is yet to come. A global bear market may be just getting started. So you see all this stuff in the news, and a lot of investors get worried. And then on the nightly news and the daytime news, you start to see all these stories. Worst December since 1931. This was the day after Christmas.
Well, the uncertainty about the shutdown adding fuel to the free fall on Wall Street. The Dow taking another plunge Christmas Eve, dropping down nearly 12% on the year. Chief business correspondent Rebecca Jarvis has more at the New York Stock Exchange this morning. Good morning, Rebecca.
Good morning, Amy. Yeah, this is typically the time of year that's known as the Santa Claus rally, where stocks see a bit of a boost between Christmas and just after New Year's. And while it's possible, according to traders here at the New York Stock Exchange, that we see a bump in the coming days, this has been a brutal month for December. In fact, it's the worst December on record since the Great Depression in 1931. And there are a number of factors contributing to this sell-off that we've seen. First of all, interest rates are rising. The uncertainty over the trade deal with China, that uncertainty has been an overhang here on the markets for months. And finally, a global slowdown in the world economy. Add to that the political uncertainty with the government shutdown here, President Trump continuing to lash out at the Federal Reserve, and efforts by the Treasury to try to soothe and calm things down, instead creating unease among investors here on Wall Street. All of those things combined have contributed to this sell-off that we've seen in recent days and, frankly, recent weeks.
All right, and a lot of people people want to know this because there are many who believe this slump will continue into the new year.
Well, Amy, if you look at the current economy, things are looking pretty decent. You have the unemployment rate at a 49-year low. Job gains are continuing at a healthy pace. And we just wrapped up one of the best holiday seasons in years, a record number of dollars spent between November 1st and December 24th, according to MasterCard. All of those things look good. It's the uncertainty that lies ahead. And that's where investors look to next year and say, things might not be getting better.
Things might not be getting any better. Here's what I can tell you. I've been through enough of these to know it will end. Bad times never last. But when you're going through it, it feels like slow motion because it's day after day, week after week, and sometimes, like the last quarter, month after month. But then look at this. 2 days after Christmas Eve, we're closed to Christmas, right? Dow and S&P have the biggest two-day gain since 2015. The day after, the December 26th, Dow soars 1,086 points in one day. That's almost 4.98%. In one day. We can't miss those days. Okay, the people that bailed out the week before and the couple weeks, 2-3 weeks before, they missed that day. And the coming weeks after that day. And then this is January 18th, 2019. Stock market hasn't started a year this strongly since 1987. Whatever the current circumstances are, it tells you nothing about the future. You can't extrapolate it, whether it's good or bad. These are all the downturns since the financial crisis. The average downturn, and look at all of them, was 9.3%. There were 23 greater than 5%, 11 greater than 9, 8 greater than 10%, 3 greater than 17%, and 2 greater than 20. The last one, in the year 2011. And these are all the different reasons that they went down. It's a different reason every time. What happened after every single one of these downturns? It ended, and it went out to new highs. This is the latest reasons: Fed interest rate hikes, fears of a global slowdown, position unwinding, government shutdown, and machine trading. And then we have the government shutdowns, right? Wow. Politicians using fear to manipulate.
The White House has issued warnings over the past 2 weeks that have sounded downright dire.
Federal prosecutors will have to close cases and let criminals go.
We are going to be a nation that is going to be less safe.
It's going to be very painful for the flying public.
That was October 2013. Different politicians at that time. But no matter what time it is, no matter what government shutdown it is, the media is relentless. No matter what channel you watch, as soon as there's an announcement, there goes the countdown clock. Countdown to shutdown. That was January 19th, 2018. That wasn't even the last one that we just went through. This was December 21st, 2018. Again, countdown to shutdown, all these different channels. And then the media starts going at all kinds of different reasons why it's going to be devastating to everybody and the economy. And then here's January 18th, 2019. The 3 major stock indexes have risen more than 10% since December 24th during the shutdown. Stock market has jumped 12% since it began. So here's all the government shutdowns since 1976. There were 21 of them. 21 shutdowns since 1976. There was only 2 where the market was negative 1 year later. So the light green is 1 year later, the dark green is during the shutdown. Only 2. And I can say rather confidently that the markets were probably not down because of the government shutdown a year later. Now, only 7 had negative returns during the shutdowns. Only 7 out of 21 were negative during the shutdowns. Government shutdowns are just background noise for us. It's just one of trillions of variables that go into stock market prices. I'll get into this in greater detail in the next class, but I want to touch on it real quick because you have to see how many variables go into market prices. All these things we know, statistics, facts, data, information, financials, news, we know that right now, but news changes instantly, minute by minute, day by day. And then we don't know what the future information and news will be. All these things go into market prices too, and they are unknowable. People's instincts, feelings, dreams, visions, preferences, perceptions, plans, bad data, all the fraud that goes on in the financial industry. But even perceptions, it could be as simple as, what did all 7 billion people in the world have for breakfast this morning? It could be as simple as that. That's how many variables there are that go into market pricing. And then, of course, there's the weather and natural disasters and wars and currency crisis and man-made disasters and those political decisions going on in the back rooms all around the world. And these are the things that I'm going to be touching on today. Technology discoveries, medical discoveries, and mutating technology. All unknowable. Future will always be uncertain. You'll hear me say this a lot. Things will change for reasons unknown to us at the present time. That is a fact, and performance will be different every year. The returns will continue to change in unpredictable ways. So how do we deal with uncertainty as investors? Because the future is always uncertain. Well, one of the things we do is we get high quality fixed income to mix with our stocks, and you get a mix of allocation of stocks and high quality fixed income. And we want shorter durations because the longer term bonds, 20 years, 30 years, 35-year bonds, they could be just as volatile as stocks. Why would I want to own a bond that's just as volatile as a stock when I can be in ownership in a company? The other thing that we do, most of you have even lesser of a percentage in stocks because you have other assets, like you have money market accounts. You know, Scott and I, we kind of make sure that you have enough savings outside of markets. CDs, checking accounts. Some of you have fixed annuities, the high quality fixed annuities and index annuities, the commission-free ones that we can get for you. And then a lot of you have rental real estate that you've owned for 10, 20, 30, 40 years or more. And you didn't sell it because of a temporary downturn in your real estate. And some of your real estate had some pretty significant downturns along the way. It did. And if you need additional real estate, you know, Scott and I can do some of the publicly traded, really low-cost real estate investment trusts for you also. So both you and I, we have a plan in both up and down markets. We're going to relentlessly stick to these fundamentals. We're going to ignore market predictions and forecasts from the gurus. They don't have a clue what's going to happen in the future. They don't. Diversification, we're going to have worldwide diversification and diversification in asset classes with different correlations. Know your risk. This is what I'm going to cover in detail in the next class. Your volatility levels in your particular allocation. It's very important to know your risk. Low turnover. We're going to reduce the hidden expenses and have really low cost funds in the portfolios. The average return includes the upside volatility and the downside volatility. Our average returns are positive over longer periods of time. So we want to be in it to get those really good periods. And then rebalancing, systematic, disciplined rebalancing on a calendar basis on highs and lows. So thank goodness we had that fixed income in our portfolios during December, because in January we were able to take all the dividends that we earned from our stock funds in cash, and we were able to take some of the bond funds up in December, take a little bit of that and buy some of the stocks in January when we rebalanced. So I own these allocations, Scott owns these allocations. In the next class, I'm going to show you all my statements. That's the next class, we do all that for you. I'm going to stay prudent, stay diversified worldwide, stay diversified in many asset classes, not just stocks. I have, money market, I have, a checking account, I have some real estate, those types of things. Stay disciplined and patient. I'm going to rebalance small amounts out of hot asset classes and funds, rebalance small amounts into down asset classes and funds, keep my risk consistent, and above all, avoid forecasting, predicting, guessing, and market timing. I'm going to do that for me and my family. Scott's going to do that for him and his family. And Scott and I are going to do that for you and your family. Here's one of the things that we can't do, okay? You guys have to be able to pick a portfolio that you can live with no matter what comes. And it's with my guidance and Scott's guidance that we're getting you in hopefully the correct portfolio for your circumstances. And we look at your entire net worth, your entire income, and make sure that that's the proper portfolio for you. You must be able to handle the downturns both financially and emotionally. Scott and I are very confident that you guys can handle it once we make the recommendations for you, that you can handle it financially. Emotionally might be a different story. Okay? We've had people tell us, oh yeah, I could take that higher risk portfolio, and the first downturn they go through, they panic. It doesn't happen very often because we do these classes. Okay? And it's usually the newer investors that haven't been through a downturn before. So emotionally is a big factor. We can create the most beautiful portfolios for you and the most beautiful allocation, but if you panic during a downturn, you're going to cause yourself permanent loss that can't be made up. Investing does right. Oh, this is a key though. This is provided you are already prudently invested. If you're speculating and gambling with your money, or you're doing crazy investments, you can throw all that stuff out the window. Investing done right is simple, but extremely hard to do over long periods of time.